If you are looking at your screen right now, you're not just seeing red candles. You are witnessing a coordinated event. Silver didn't sell off. It didn't correct. It didn't react to sentiment. It was forced. In a single trading session, the silver spot price collapsed more than 4%. Billions in paper value vanished. Stops were triggered. Margins were called. Retail traders panicked. Social media erupted with one word: manipulation. But manipulation is not the story. It is the distraction. Because while everyone was staring at the New York chart, while headlines screamed about volatility, while commentators blamed speculators and macro uncertainty, almost no one noticed the most important anomaly in the global silver market, a price that should not exist. At the exact same moment New York was dumping silver at $74 an ounce, Shanghai was buying it above $82, an $8 spread. Not a rounding error, not a timing issue, not a temporary inefficiency. An $8 gap in a globally traded commodity is not a market signal. It is a crime scene. In functioning markets, price differences trigger arbitrage. Metal flows from low-price regions to high-price regions until equilibrium is restored. That is not theory. That is the foundation of global trade. And yet, this spread did not close. It widened. Earlier that same morning, silver was trading as high as $86. Within hours, Western paper markets collapsed, while Eastern physical demand absorbed everything it could get. This is not a story about charts. It is not a story about sentiment. And it is not a story about technical levels. This is a story about law. Because the reason this arbitrage failed, the reason metal is not flowing freely, the reason price discovery has fractured into two separate realities, has nothing to do with supply and demand. It is written in the Federal Register, hidden inside a document that 99% of investors have never read. An executive order, a modification, an annex, a legal mechanism so obscure that even seasoned market professionals missed it, yet powerful enough to quietly override decades of commodity trade norms. Executive Order 14346. Most people have never heard of it. Even fewer understand it. And almost no one has connected it to what is happening in silver right now. But that order, and specifically what was changed inside Annex 2, is the architectural blueprint of the chaos you're watching unfold. While mainstream media obsesses over tariffs on electric vehicles, while pundits debate semiconductor trade wars, while analysts argue over inflation prints and Fed language, the real system shock happened silently. On page 7. No press conference, no headline, no market warning. Just a quiet legal adjustment that redefined how strategic materials move across borders. Who can move them, when they can move them, and under what conditions they can be withheld. Silver is one of those materials. And once you understand what Annex 2 actually does to the silver supply chain, you will realize why selling into this panic is exactly the wrong move, and why the real stress has only just begun. Because this is not volatility, it is not speculation, it is not fear, it is structural. The Western silver market is not under pressure. It is broken. For decades, the system relied on paper contracts to simulate liquidity. Futures, forwards, unallocated accounts, all designed to keep prices stable without requiring physical delivery. That system only works as long as physical metal can be sourced when needed. That assumption is now failing. Metal is draining from west to east at a pace not seen since the 1970s. Vault inventories are declining. Delivery times are stretching. Premiums are rising quietly, off-screen. And yet the paper price keeps falling. That contradiction is not accidental. It is engineered. Because when arbitrage is legally obstructed, price is no longer a discovery mechanism. It becomes a policy tool. This is why the spread persists. This is why Shanghai keeps paying more. This is why New York keeps selling lower. And this is why the usual market forces are not correcting the imbalance. The law is preventing them from doing so. Most investors are trained to look at charts. Some are trained to read balance sheets. Very few are trained to read executive orders. That blind spot is costing people money. Because the disconnect that defies every law of global arbitrage does not exist on a trading platform. It exists in regulatory text, language written in legal terms, but enforced in physical reality. Once Annex 2 was modified, silver stopped being just a commodity. It became a controlled strategic material. And controlled materials do not trade freely. They move according to permissions, exemptions, and political priorities. That is why paper silver can collapse while physical silver disappears. That is why futures can be smashed while premiums quietly rise. And that is why this event did not begin with a crash. It began with a document. In this investigation, we are not going to speculate. We are not going to panic. And we are not going to repeat surface-level narratives. We are going to dissect the mechanics. We are going to break down exactly what Executive Order 14346 changed, why Annex 2 matters, and how a legal modification most people ignored is now reshaping the global silver market. This is not a theory. It is a paper trail. And once you see it, you will understand why this sell-off was not the end of something. but the opening act. To understand why silver prices are behaving in ways that defy every rule of global markets, you have to abandon the chart. You have to abandon the commentary. You have to abandon the idea that price is always discovered in the open, because what broke the silver market was not a trade, not a fund liquidation, not a macro shock. It was a legal reclassification, and it happened quietly. Executive Order 14346 did not announce itself as a metals policy. It did not mention silver in bold letters. It did not trigger an emergency alert. Instead, it did something far more effective. It changed definitions. In modern financial systems, definitions are power. They determine what can move, who can move it, and under what authority it can be stopped. EO 14346 expanded the scope of what the U.S. government defines as strategic materials, materials deemed critical to national security, energy transition, and technological independence. The headline focus was electric vehicles, semiconductors, rare earths. But buried inside Annex 2 was language broad enough to capture industrial precious metals, including silver, without ever needing to name it explicitly. That ambiguity was not accidental, because once a material is swept into a strategic classification, normal market rules no longer apply. Exports become conditional, licenses become discretionary, delivery timelines become political, and most importantly, arbitrage becomes illegal without ever being called illegal. This is where price discovery breaks. In a normal world, if silver trades at $74 in New York and $82 in Shanghai, metal flows east. Traders buy low, sell high. Physical silver leaves Western vaults, the spread collapses. That is how markets heal themselves. But under EO 14346 framework, that flow can be delayed, throttled, or denied. Not through bans, but through review processes, national interest assessments, and temporary controls. Paper silver is still free to trade. Physical silver is not. This is the key distinction that most investors miss. The futures market did not break first. The physical supply chain did. Western exchanges price contracts, not metal. Those contracts assume metal can always be sourced if delivery is demanded. That assumption is now false. Because once Annex 2 came into force, large-scale exports of certain industrial inputs became subject to review. Silver is an industrial input. It is used in solar panels, electric vehicles, medical devices, defense systems, high-efficiency electronics. In other words, silver sits at the intersection of every sector EO 14346 claims to protect. So while headlines screamed about EV tariffs, the actual choke point was upstream, metal availability. This is why Shanghai can pay more. China is not pricing silver as a speculative asset. It is pricing silver as strategic inventory. And China is willing to pay premiums for certainty. The West, meanwhile, is still pretending silver is a paper derivative. That mismatch is lethal, because when physical demand is real and paper supply is infinite, the price signal becomes inverted. Lower prices do not signal abundance, they signal stress, and that stress shows up first in spreads. An $8 gap is not market noise. It is a warning flare. But warnings only matter if someone is looking. Most are not. Because the mainstream financial media does not read executive orders. It reacts to price. And price, in this case, is being artificially suppressed by a paper market that no longer has physical backing. Here is what Annex 2 effectively did. It created a two-tier silver market. Tier 1, paper silver, futures, ETFs, unallocated accounts, cheap, liquid, infinite. Tier 2, physical silver, bars, industrial-grade supply, deliverable metal, restricted, delayed, politicized. When those two tiers diverge, charts lie. This is why retail traders panic at the wrong time. They see price falling and assume demand is collapsing. In reality, demand is exploding, but only in the physical channel, and that channel is now legally constrained. This is also why Western vault inventories are draining quietly. Metal is not being dumped, it is being pulled. Refiners are shipping east, manufacturers are locking supply. Governments are prioritizing domestic stockpiles, all while futures traders are still playing a game that assumes free movement. That game is over. EO 14346 did not need to ban silver exports outright. It only needed to introduce enough friction to break arbitrage timing. If delivery takes longer, if approvals are uncertain, if paperwork delays shipment, then arbitrage capital disappears. No trader will risk capital on a spread if they cannot guarantee delivery. And once arbitrage dies, price disconnects permanently. This is exactly what we are witnessing. The Shanghai Gold Exchange is not overpaying. It is revealing the real price of silver under physical constraint. New York is not undervaluing. It is pricing a synthetic product divorced from reality. This is why calling this manipulation is insufficient. Manipulation implies intent by traders. What is happening here is structural coercion. The system itself is enforcing divergence, and that divergence will not resolve itself through normal market cycles, because the law has changed. Another critical element of EO 14346 is how it interacts with compliance risk. Banks, logistics firms, insurers all operate under risk frameworks. When a material falls under strategic review, risk managers step in. Financing becomes more expensive. Insurance premiums rise. Shipping contracts tighten. None of this shows up on a chart, but all of it affects flow. This is why silver can collapse on paper while becoming harder to source physically. This is why premiums rise quietly while spot prices fall loudly. And this is why investors who only look at screens are systematically misled. There is another layer to this that is even more dangerous. Once physical scarcity becomes undeniable, paper markets face a choice. They can allow price to rise, or they can change the rules. Historically, they choose the latter: position limits, cash settlement incentives, force majeure clauses. EO 14346 provides the legal cover for all of it, because once a material is deemed strategic, market integrity takes a back seat to national interest. And national interest is not obligated to honor futures contracts. This is not speculation. It is precedent. We have seen it with energy, we have seen it with food, we have seen it with rare earths. Silver is simply the next domino. The crash you are watching is not capitulation, it is preparation. Weak hands are being flushed, paper positions are being cleared, leverage is being reset, so that when physical repricing finally forces itself onto the screen, there is less resistance. EO 14346 did not cause silver to fall. It made silver ungovernable by paper alone, and markets hate what they cannot control. This is why the response has been violent, sudden, disorienting. It is not a reaction to data. It is a reaction to loss of authority. Because once physical markets dictate price, centralized control erodes, and that is the real threat. This is why Annex 2 matters more than any CPI print, more than any Fed speech, more than any technical breakout. It rewired the supply chain. And rewiring supply chains takes time to surface in price, but when it does so explosively. We are still in the denial phase. The charts say one thing, the vaults say another. This tension cannot last, but it will not resolve gently. Because the longer paper prices suppress reality, the more violent the adjustment becomes. And that adjustment will not start in New York. It will start where physical silver is already being repriced, off-screen, off-exchange, and outside the narrative. At this stage, it should be clear that what is happening in silver is not an anomaly. It is a process. And like all systemic breakdowns, it does not begin where people are looking. It begins at the edges, in logistics, in legal language, in quiet operational failures that compound over time. Paper markets do not fail suddenly. They fail progressively, then catastrophically. And silver is now deep into the progressive phase. To understand why the next phase will not be orderly, you have to understand how paper silver actually works. Most investors believe futures contracts exist to facilitate price discovery. In theory, that is true. In practice, futures markets exist to delay delivery. The vast majority of silver contracts are never settled in metal. They are rolled, netted, offset, or cash settled. This is not fraud. It is design. The system was built on the assumption that physical delivery would almost never be required at scale. Because for decades, that assumption held. Silver was abundant. Above-ground stockpiles were large. Supply chains were global and fluid. But that world no longer exists. Industrial demand has exploded. Strategic stockpiling has returned. And legal constraints have fractured the global flow of metal. EO 14346 did not need to touch futures markets directly. It only needed to interfere with delivery certainty. Once delivery becomes uncertain, futures contracts stop functioning as price anchors. They become speculative instruments detached from reality. This is where stress begins to accumulate, because every paper market relies on a critical illusion that if enough people demand delivery at once, the metal will be there. That illusion is now cracking. COMEX warehouses report inventory. But inventory is not availability. Much of that metal is already spoken for, allocated, encumbered, promised multiple times over. And as legal and logistical friction increases, the willingness of holders to part with physical silver declines. This is how squeezes begin, not with panic buying, but with refusal to sell. At first, exchanges manage this quietly. They increase margin requirements. They discourage delivery. They offer financial incentives to settle in cash. These are early warning signs, not of stability, but of fragility. Because a healthy market does not need to bribe participants to avoid delivery. A healthy market welcomes delivery. Silver markets no longer do. And that is where history becomes instructive. Every time a paper market loses control of a physical commodity, the same pattern repeats. First, volatility spikes, then spreads widen, then trust erodes. Finally, the rules change. In the 1970s, it was gold. In the early 2000s, it was energy. In recent years, it has been food and rare earths. In every case, governments intervene not to stabilize price, but to stabilize control. EO 14346 is part of that lineage. It does not explicitly target silver markets. It does something more subtle. It creates the legal justification to override them. Once a commodity is framed as strategic, normal market obligations become secondary. Delivery can be delayed in the national interest. Exports can be reviewed for security considerations. Contracts can be modified under emergency provisions. None of this requires declaring a crisis. It only requires redefining priorities. This is why investors waiting for an obvious trigger will miss it. The trigger has already been pulled. What we are watching now is the slow motion effect. Paper prices are being pushed down, not because silver is unwanted, but because control is being reasserted. Lower prices reduce demand. They discourage hoarding. They flush leverage. This buys time. But time is not resolution, because physical demand does not disappear. It accumulates. And when it can no longer be met quietly, pressure transfers from price to structure. This is where ETFs enter the equation. Silver ETFs are marketed as exposure to physical metal. In reality, they are exposure to custodial promises. Those promises depend on the same delivery assumptions as futures contracts. Metal is held by authorized participants. Creation and redemption rely on smooth logistics. Custodians rely on legal clarity. EO 43346 complicates all three. If metal movement becomes restricted, ETF mechanics slow. If exports face review, creation becomes difficult. If strategic classification applies, custodial obligations become negotiable. This is not hypothetical. ETF prospectuses are filled with clauses that allow for extraordinary measures under extraordinary circumstances. Most investors never read them, but lawyers do, and lawyers write the exits long before investors notice the doors closing. This is why ETF flows can become misleading. Outflows may not reflect selling. They may reflect inability to source metal. Premiums may rise outside the ETF structure while net asset values remain suppressed. This divergence creates confusion, and confusion favors institutions. Retail investors react to price. Institutions react to access. Right now, access is tightening. This is also why physical dealers report shortages, even as spot prices fall. That contradiction is not accidental. It is diagnostic. It tells you where the stress is concentrated. Paper markets can print infinite supply. Physical markets cannot. And once legal constraints limit movement, the two markets decouple permanently. This is when price becomes unreliable, not temporarily, structurally. At this stage, the only thing holding paper silver together is confidence that delivery will never be demanded en masse. That confidence is eroding, not because of retail investors, but because of industrial users. Solar manufacturers do not speculate. Defense contractors do not trade charts. Medical suppliers do not roll futures. They secure supply. And when supply becomes uncertain, they lock it up. Long-term contracts, prepayments, strategic stockpiles, none of this shows up on exchanges, but all of it drains availability. This is why the West is losing physical silver to the East. China is not playing a market game. It is playing a supply security game. It is willing to pay premiums today to avoid shortages tomorrow. Western markets, constrained by paper logic and legal ambiguity, are slow to respond. This creates asymmetry, and asymmetry is instability. The longer this persists, the more extreme the eventual repricing becomes. But repricing does not happen gradually in broken markets. It happens suddenly, often after a failed delivery event. A missed shipment, a delayed redemption, a force majeure clause invoked quietly. When that happens, confidence collapses. And once confidence is gone, paper markets have only two options: reprice violently or change the rules. History suggests they choose the latter until they can no longer avoid the former. EO 14346 gives regulators cover for both paths. It allows intervention without admitting failure. It allows delays without default. It allows temporary measures to become permanent realities. This is why silver is being allowed to fall. It is not weakness, it is containment. Because a rising silver price would signal scarcity, and scarcity undermines control. Lower prices, paradoxically, create complacency, until they don't. This is also why mainstream narratives are lagging. By the time analysts acknowledge structural failure, the opportunity is gone. They will call it unexpected. They will call it a black swan. They will call it unprecedented. It is none of those things. It is documented. It is legal. And it has been unfolding in plain sight, but only for those willing to look beyond the chart. At this point, silver is no longer just a metal. It is a stress test, a test of whether paper promises can survive in a world where physical control matters again, a test of whether law can override markets indefinitely, a test of whether investors understand the difference between price and value and access. That test is ongoing, and it has not reached its breaking point yet, but it is getting closer, because the longer paper markets suppress reality, the more force is required to maintain the illusion. And force always leaves evidence, in spreads, in delays, in legal language, and eventually in failure. Every financial system survives on one fragile assumption, that trust will arrive before reality does. For decades, the silver market operated on this premise, not because it was honest, but because it was efficient. Paper contracts replaced metal, promises replaced delivery, confidence replaced verification, and as long as no one asked too many questions, the system worked. But systems do not fail because people panic. They fail because reality eventually demands settlement. What Executive Order 14346 did, quietly, methodically, and legally, was accelerate to that moment, not by attacking silver directly, not by banning ownership, not by declaring emergency, but by altering the legal environment in which silver moves. And when the legal environment changes, markets must obey, even if they pretend otherwise. This is the final piece most investors still do not understand. Markets do not exist above the law. They exist inside it. And once the law changes, price becomes a lagging indicator. The silver market crash you witnessed was not a collapse of value. It was the collapse of an illusion. The illusion that paper and metal are interchangeable. The illusion that delivery is guaranteed. The illusion that arbitrage always restores balance. EO 14346 shattered those assumptions. Not loudly, not dramatically, but permanently. Because Annex II did something unprecedented in modern commodity markets. It allowed strategic necessity to override market neutrality without ever declaring a commodity controlled in the traditional sense. That subtlety matters. Traditional controls are visible. They trigger reactions. They provoke resistance. EO 12346 is invisible to most market participants and therefore far more dangerous. It operates through compliance risk, through licensing ambiguity, through delayed approvals, through silent friction, and friction is enough. Once friction exists, delivery becomes uncertain. Once delivery becomes uncertain, arbitrage retreats. Once arbitrage retreats, price fractures. That fracture is what you are seeing now. Two silver markets, one real, one synthetic. The real market is physical, constrained, strategic, and increasingly sovereign. The synthetic market is liquid, leveraged, price-suppressed, and politically convenient. For now, they coexist. But coexistence is not stability. It is tension. And tension always resolves. The question is not if, it is how. Because from this point forward, only three outcomes are possible. Outcome 1, violent repricing. This is the scenario most investors imagine, and paradoxically, the one policymakers fear the most. In this outcome, physical scarcity becomes impossible to hide. A failed delivery, a delayed ETF redemption, a refinery shortfall, a sovereign purchase that drains available supply. Something breaks publicly. When that happens, paper markets lose credibility overnight. Price does not rise gradually, it gaps. Margin systems fail. Short positions scramble. Liquidity disappears. Silver reprices not as a commodity, but as a strategic asset. This outcome is clean, but it is destabilizing. It exposes leverage. It punishes paper holders. It rewards physical control. Historically, authorities try to avoid this outcome at all costs, which is why it rarely happens first. Outcome 2, rule change. Before failure. This is the more likely path, and the one EO 12346 quietly enables. Instead of allowing markets to fail visibly, the rules are adjusted. Delivery incentives increase. Cash settlement becomes encouraged. Position limits tighten. Emergency provisions are invoked. None of this is framed as failure. It is framed as market stability. In practice, it means one thing. Paper silver is decoupled from physical silver permanently. The price you see becomes a policy artifact, not a market signal. Physical silver trades at premiums outside the system. Inside the system, price is managed. This outcome preserves order, but destroys trust. And once trust is gone, markets never fully recover. They persist, but they no longer function as discovery mechanisms. They function as control mechanisms. Outcome 3, gradual drain, silent reset. This is the slowest outcome, and the one currently unfolding. Physical silver continues moving east. Strategic stockpiles grow quietly. Western inventories decline slowly. Paper prices remain volatile but suppressed. Retail interest fades. Media attention shifts. Until one day, without announcement, the available physical supply is simply gone. No panic, no crash, just absence. At that point, markets do not explode. They hollow out. Silver still trades. Contracts still exist. But the metal no longer circulates freely. This is how systems end without drama. And it is the most dangerous ending of all. Because by the time it is obvious, there is nothing left to react to. EO 14346 does not force any one of these outcomes. What it does is remove the system's ability to self-correct. And once self-correction is gone, intervention becomes the only stabilizing force. That is the real shift. Markets have not become volatile. They have become subordinate. Subordinate to law, subordinate to strategy, subordinate to national interest. Silver is simply the first metal where this subordination is visible. Gold will follow. Copper will follow. Energy already has. The era of neutral commodities is ending, and with it, the era of passive price signals. This is why the crash mattered. Not because silver fell, but because silver fell while reality tightened. That divergence is the tell. That is how you know something fundamental has changed. Retail traders selling into this move are not wrong emotionally. They are wrong structurally. They are responding to price, not to access. Institutions are not confused. They are repositioning, not into ETFs, not into futures, into contracts with delivery certainty, into bilateral agreements, into sovereign-aligned supply chains. This is where value migrates when markets fracture. And it does not come back easily. Because once governments realize they can influence markets without overt controls, they do not relinquish that power. EO 14346 is a template, a model for managing scarcity without declaring it, for rationing without announcing it, for controlling flows without admitting control. This is why it matters far beyond silver. It signals a shift in how economic stress is managed in the modern era. Not through transparency, but through legal architecture. And legal architecture is invisible to charts. This is why most investors will miss the next phase. They will wait for confirmation in price. But price is no longer the messenger. Law is, and law moves first. By the time price reflects it, positioning is already done. This is the final warning embedded in this entire investigation. Do not confuse volatility with weakness. Do not confuse falling prices with falling demand. And do not confuse legality with fairness. The silver market did not crash because it failed. It crashed because it was too important to be allowed to function freely. That is the paradox. And that is the truth hidden behind Executive Order 12346. The document most investors never read has already reshaped the market they think they understand. And once you see that, you cannot unsee it. Because from this point forward, silver is no longer just traded, it is governed. And governed assets do not obey charts. They obey priorities. Those priorities are shifting. Quietly, legally, relentlessly. The crash was not the end. It was the signal.